Hey everyone, welcome to episode number 1 of the hotel series of the Stage Debate podcast. This is something that we've been working on for a while. Yes, Stage Debate came out 8 months ago and we've knocked out 10 beautiful multifamily episodes. We have no words to thank our episode, corporate, and all other sponsors for the multifamily series, as well as our guests, our listeners. We had some great conversations. I met some great people, but right now it's hotel time. And I'm excited to bring on some fabulous and well-respected guests onto the show today. We have Mitch Patel from Vision. We got Jatin, Desai from Peachtree, and we got Amin from Geary. Folks I've had the pleasure to work with, and folks that are just have made tremendous moves in the space and are well-respected. So first, we just want to thank them. They took out of their schedule to come on. We very, very exciting talk today about a lot of different array of topics, and it's just going to be tremendous. But none of this would be possible without our special sponsors. And especially when the sponsors are your friends, it makes it even better. So first and foremost, our corporate sponsor, really like our cornerstone sponsor, Michael Stern. He's been with me from the beginning, believed in me. Michael Stern of Line Star Tax and LSD Consultants, tax geniuses. He's worked with some huge folks in the space, really structuring your taxes the right way and really helping you out. And obviously, taxes is such a nuanced item. And you really don't know when you go to an accountant or an outsourced CFO if they tell you, hey, this is your bottom line. Is that really my bottom line? But dealing with Michael, you will know that he's going to get you the best bang for your buck. He's worked with some of my clients and the results have been literally unbelievable. Definitely reach out to Michael of Line Star Tax and LSD Consultants. We did something new for the hotel series. We brought on a series sponsor. We didn't do this in the multifamily series. Our series sponsor is a great friend of mine, one of my favorite folks in the hotel space. His name is Himesh Jaram. A lot of you are familiar with him. He services some of the biggest folks in the hotel space. But even if you have a small hotel, even if you only have 1 or 2 in your portfolio, definitely somebody to reach out to. He's the founder of Ameritech Distribution, LG TVs for your hotel. Definitely competitively priced. He's a very service-minded individual. I've had the pleasure to work with him. We have mutual clients. Definitely somebody that you will not be disappointed with if you reach out to. And last but not least, a great friend of mine in the hotel space, Kishan Patel of KDP Law. Kishan is a smart, savvy, again, service-minded individual that brings a tremendous amount to the table. Obviously, when it comes to legal stuff, things can get complicated. Things can get confusing. Having a guy like Kishan on your team really helps you in a way and takes some big stuff off your shoulders, knowing that this is a guy you can trust. He's worked with some of the biggest folks in the space. He does have an hotel arm of the business as well, which gives him that edge of the in and out look of what the daily operations and the legal stuff of owning a hotel can be. So definitely somebody that you should be in touch with for your closing and build that relationship with him. Kishan is a great man. And again, I want to thank all of you. There's going to be a lot of hotel listeners. The pleasure that I've had to work with many of you over the last few years, and we're just getting started. So tune in to this episode. If you'd like to sponsor an episode in the future and get massive visibility, reach out to me. Tune in, guys. Let's go. Hey, everyone. Welcome back to another episode of the Stage Debate podcast. But we have a twist today, and it's a very, very exciting day for me. Today is the first episode of the hotel series of the Stage Debate podcast. So we just finished the multifamily series. We're diving deep into the hotel space, something that I've been very, very passionate about for the past 2 years or so. We have some of the superstars in the hotel space, Amin from Giri Hotels, Mitch Patel from Vision Hospitality, and Jatin Desai from Peachtree. So obviously these are well-known names in the space, and I'm honored that you guys chose and were willing to come on to have a discussion today and help out new hotel owners, talk about what's going on in the market, the good things, the things that are stressful right now, and just some of your journey to help pave the way for new guys, because obviously there's always new guys entering the space and people that could really use your advice. So thank you guys so much for coming on. Thanks for taking out of your schedule. What we're going to do is each of us are going to introduce ourselves. So we'll take a minute or two to just introduce yourself and your company, what you're working on today. So let's start with Ryan Amin from Giri Hotels. Ryan, it's a pleasure to be your friend. You're just such a good man. I appreciate you coming on. Tell us a little bit about how you got to where you are today, Tell us a little bit about your company. We would love to hear.
Yeah, no, thanks for having me, Isaac. So, Ryan, I mean, one of the principals at Geary Hotels. So, we own about 50 plus hotels, a bunch of restaurants, golf clubs, and some financial softwares. So, how I started was actually my parents owned a small motel. So, when I was about 13, that's how I actually started learning the industry. It was a 15-unit motel built in the 1940s, so it had a specific type of customer. And that's when you kind of had to learn on the job. And it's funny because when I was in that moment, I didn't really appreciate it, but looking back on it, I'm glad I had that experience. So something as simple as my dad always pushing it and trying to find something to improve. He was a risk taker. He is a risk taker. And then my mom kind of teaching me the basics of the business, right? Like I remember at 13 counting the cash deposit at the end of the month, right, for the bank, and how meticulous she was reviewing every statement in the morning and night. So that's how I got started. I went off to college, installed some surveillance cameras as a side hustle for actually hotel owners and convenience stores. And then I graduated, worked in corporate life, saved enough money, and then bought my first hotel in Southern Maine.
We have Jatin Desai from the Peachtree Group. You guys are a household name. Folks know you. You guys have really two arms to your business. You have obviously the hotel holdings side of the business. You guys have a debt platform, and you guys have worked with so many of the good folks in the space and continue to make big moves. Tell us a little bit about Peachtree, about yourself, and about how you guys evolved over the years.
Sure. So similar to Ryan, I grew up in the business with my family, having a small, motel in North Carolina, did all the things that you'd expect that your parents owned a motel, right? So from housekeeping to accounting to whatever the case was, right? So there's an education on in the actual practice, right? So it was great. And like Ryan, I completely appreciate it today because it gave you kind of a foundation to build upon. I went to UNC Chapel Hill and graduated from there and worked at a bank in investment banking. This was pre-GFC, so it's a huge market run up. Real estate was wild, financing was wild. You could get a property built with very little cash and huge amounts of debt. Obviously, that came to an end in 2008, 2009. But prior to that, we just kind of saw some things trading at the bank, and I decided to go back and sell our family business in 2006 and into 2007. And that's around the time that I met my partners here at Peachtree, Matul and Greg, and started kind of the platform here with them and built upon what they had already kind of started in the early parts of 2007. So we, at the time launched a equity platform where we bought assets to renovate, to improve, via renovations, and then build properties from the ground up. And then when the GFC hit, we used our network of banking contacts to really go out and find debt to buy at a discount and restructure, right? So we weren't trying to go to do loan to own or anything else like that, but really restructure debt to get paid off and move on to the next credit. And that really, when the market stabilized, that led to our finance originations business. So we started doing originations on the debt side, continued to develop hotels, continued to buy hotels. And we started branching out beyond just hotel assets. So we'd finance multifamily, we finance land, we finance industrial, retail across the CRE spectrum. Today we have about 300 people at our corporate office. We've raised a variety of funds, a number of funds, and we're on fund number 14 right now for the credit side. So we've just continued to grow and evolve and build a backbone that's centered around real estate and add things onto it that are complementary, and we can leverage our current structure. So that's a little bit about us.
John, that was super interesting. Wow. I have a lot of questions for you. We'll see if we get to it on the pod. If not, we'll get to it in Atlanta. Mitch, fill us in. Obviously, Vision Hospitality is it's a big player in the space, but I believe you have a tremendous amount of respect out there for what you've done, what you've built up. And excited to hear you speak and moderate a panel at the Hunter Conference. I've always respected you. I see your stuff on LinkedIn. Tell us a little bit about yourself, how you got started.
Sure, Isaac. First of all, thank you for having me, and congratulations, Jatin and Ryan, on all your success. So, similar story, Isaac. I grew up in the motel business. It was an 11-room motel. We lived at the apartment behind the motel office, so clean rooms, did laundry, took out trash. Then eventually, my parents wound up buying a little bit larger motel and moved cross country from California to Tennessee. And again, found myself helping out in the family business. And because I grew up in the business, that's the last thing I want to do is pursue it as a career. And it was that immigrant mentality, right? Our parents would work hard and would make these huge sacrifices so we can be a professional. They did not want me to be in the motel business, right? Be a doctor, be a lawyer, be an engineer, and you'll probably get a good girl, right? That's their message. And so I took the least resistant path and became an engineer and went on to get my master's in traffic transportation engineering. And sorry, Jatin, I worked down in Atlanta as a traffic engineer, and I really, really couldn't do much with the mess down there. So, but I didn't love engineering. Sorry for the engineers out there. It taught me a lot, but it wasn't for me. So here I'm in my cubicle designing roads and bridges and traffic studies, and I didn't love it. I thought there has to be something more that I could do or contribute. And so I took a chance and wound up getting in this business with no capital because it's a very capital intensive business, no experience, and developed my first hotel, and then literally took off my hard hat and put on a tie. And I was the opening general manager at the age of 27. And that was the beginning of this company. So we started this company with one small hotel, but one very big dream. And today we have 42 hotels in 9 states, and we've got another 12 in our pipeline. And I found my passion where I never expected to. And I think that's a really, really important ingredient in entrepreneurial success.
So I'm intrigued about the hotel space for many different reasons. I just asset class, the owner style, the work ethic. It's something that talks to me a lot. And something that I just want to talk about initially right now is the idea when I deal a lot with the multifamily sector. So generally, the way it works is you have the traditional value add multifamily play. These deals are syndicated. And obviously, to a certain extent, the deals are controlled by investors because you have to sell, you have to refi at a certain point. Just because the property is producing a positive NOI and it's doing well, that's not a reason to hold on to it. You have your exit plan. You have to return investor money. When it comes to certain asset classes, you have this in the healthcare space a lot with nursing homes, but you have this with hotels a lot. It's not the traditional syndication play. Yes, I do have many clients that do syndicate their hotels from friends and family and other investors. But what you do find is, and correct me if this is incorrect, is that if a hotel is doing well, you're not just going to sell it off after a certain amount of years. You're going to keep it. It's producing that cash flow. The question is, talk to us a little bit about the structure of how it works, because there's going to be a lot of multifamily guys, friends and clients of mine going to be listening to this podcast. So we will venture more deep into the actual hotel world, but in terms of how it works, obviously from the traditional multifamily value add play. And by the way, this could be a pitch to many multifamily guys out there that potentially want to invest in hotels, because hotels have much higher cap rates than multifamily. And it's a very not known territory. It's like uncharted waters. So fill us in what the play is, the classic regular play on a hotel is for our uneducated multifamily listeners. Go for it, Mitch.
Sure. Look, there's a lot there, Isaac. We have a short amount of time, but I claim to know, I don't know much about the other real estate classes, but hotels is something that we, all three of us here, know extremely well. That's all we really do. Of course, Peachtree does other things too. There's so many ways to create value in the hotel space, unlike, I think, in other real estate classes. Brands, not all brands are equal, right? As you know, fast food, there's a lot of risk in fast food, right? But there could be tremendous rewards. Chick-fil-A has shown that. And so not all brands are equal. The average Chick-fil-A does $9 million in revenue. The average Bojangles does $2 million. And so this is a very transparent world that we live in. So how you operate your hotels can make a huge difference, right? If you go into TripAdvisor or even any type of portal, there's rating systems. You could see reviews, and all those things can equate to better performance. Revenue management. There's just a lot of, I guess, buttons and levers that we could pull and push and create value that way. Ultimately, it's about creating value. And so we've done it historically through development of certain brands. We're very particular about the brands that we partner with, the markets that we go into. I'm not going to get into all the details of that, and the basis. The basis is very important, and what kind of basis are we in it at? Because that's very critical. I'm looking at my entire portfolio. The hotels that are doing the absolute best are the ones that have the lower basis, the lower debt, the best brands and good growing markets. And we're operating at top of class, right? So we're getting 130, 40, 50 RevPAR index compared to our competitive set. So there's a lot of variables there, Isaac. So my advice is make sure that if you are an investor, invest with people that have a proven track record of performance in this space, because not everyone could be extremely successful. And we've been doing this for obviously 28 plus years, and we have a formula, and we're very disciplined to that formula. So, but I'll turn it over to my fellow panelists.
I would echo the same thoughts as Mitch. I'm not a real multifamily expert on the asset class, but in terms of your capital stack and your acquisition profile, it's similar. Like when you look at just numbers on a paper, yeah, there are different cap rates. There's different loan to values on deals that you're trying to capture. But within a hotel or hospitality sector, there's definitely more of a management need, right? And so to give you an example to kind of portray this, I was looking at a multifamily deal and it had 7 team members. And this is a $50 million multifamily. If you look at that on the hotel side, you would be looking at a 40, 50 person team member roster, right? So just that figure kind of tells you, okay, well, look at all the different layers. So if you take one more example, if you take a top line, okay, say you're struggling with revenue. Mitch kind of talked a little bit about revenue metrics. In a multifamily, you're saying, okay, you have a certain segment. In a hotel, you could have several different segments where you're trying to identify where you're dropping in revenue. So that alone is why you have a whole revenue management department, right? So those layers definitely add up. And then in certain economy trends, those things go up and down. So you have to be very dynamic and be able to adjust with that. I think if you're an investor, Mitch said it very well, is you have to partner up with someone who actually knows the business, right? Is able to guide you through those different components, give you those tools and tips, tells you what to watch out for. So yeah, that's how I would summarize the hotel versus multifamily investment.
So I think the biggest difference between, if the real estate industry is your hand, right, the hotel is your thumb, right? It's completely different than the other 4 fingers, right? It's very, very different. So you mentioned cap rates, right? So cap rates, multifamily trades in the 5s today, hotels trade in the 8 to 9, 7 to 9. So you have a 200 or 300 basis point spread between what a multifamily asset will trade at and what a hotel asset will trade at. Now, you look at against other asset classes, self-storage trades at 5s, 4s, 6s in that range, still 200 to 300 basis point spread between hotels. 15, 20 years ago, self-storage traded just as wide as hotels did, right? It became an institutional asset class on its own because of the amount of operations that it takes. It takes very few people to run a self-storage, just like it takes very few people to run a multi, or whatever the case is, very different than our space. But the biggest thing, if I'm looking just at multifamily, is there's government financing, right? You've got Fannie, you've got Freddie, you've got government-backed financing that's going to allow cap rates to stay somewhat compressed in the multifamily space, right? So you've got 12-month leases, we've got nightly leases, right? So when a market moves, it's a little slower for other asset classes, whether it's industrial, self-storage, multi, whatever, to kind of shift in pricing. Whereas on the hotel side, we can shift nightly. So a game comes into town and that's going to sell out this particular submarket, well, we can pop rate. Or if a storm comes in and you own airport properties, well, you can pop rate. And vice versa. If you have low demand, you can kind of flex rate. One of the very nuanced things about hotels that we as operators, owners do is we share our data with each other every night, right? And it's done through Smith Travel Research is the main company that provides this data and collects this data from all the various hotels. So every night when you run the night audit, your data goes to the brand and the brand shares it with Smith Travel. And we use that, Mitch mentioned a few minutes ago that we index off of each other. Like, I don't know what Mitch's hotel does right next door to me if we have one next door to each other, which we do. But I know that in our little submarket, I'm ranked number X, Y, or Z within that market, and I'm indexing at a 100% penetration, higher or lower than 100% to say that I'm in market or not, which is different than every other asset class. You're having to go scour CoStar or other databases to see how you're actually competing against your individual submarket. So when you look at why hotels trade at a higher cap rate, one is just financing, right? Two is the day-to-day headache of operations. And mostly it's because of the fact that it is so dependent on what brand there is out there. And, if you have a box that's got one brand versus another, it might be the exact same physical product, but the reservation system driving revenues to that property could be different. And that's what drives value from one side or another. Labor drives it, location drives it. Like if you're in California or Florida or Texas, you might have a higher operating model than if you did in Tennessee or in North Carolina. So various things that would apply to other asset classes, but truly like impact hotels on a day-to-day are there. And also one thing I'll add is that, hotels constantly need capital, right? Which is a good and bad thing, right? Because it allows, some might view it as, wow, I've got to go put money in this asset every 7 to 10 years. You have to do that in a hotel, you have to do it in office, you have to do it in multi, you have to do it in all asset classes. But we look at it as an opportunity, right? On that next renovation cycle, not only can you do an updated cost seg, you can do a brand change, or you can do a repositioning within the market within the same brand. So you can kind of increase cash flows however you see fit based on these kind of opportunities that occur because of the inefficiencies in the space.
Then, Isaac, there's probably a flip side to that without knowing your audience. But if there's the investor who wants to get into operations, I think all of us had a similar story where we were operating the hotels. So we were able to do multiple positions, right? So if you think of payroll, when it maybe takes a hotel to have 20 people, we might have been doing 8 to 10 of those jobs initially to save enough money, gain enough capital to kind of grow. So I think you have a little bit more flexibility if you're willing to put in the work to create value.
Absolutely, absolutely. And by the way, granted, when I asked that question, I know obviously it's a whole different animal. It's a whole different ball game. Multifamily kind of runs by itself. Obviously, you need the property management, but hotels are day-to-day operations. It's a real business. It's a real business. I get that. And as I was talking, like it really clicked in my head that it's really like multifamily to a certain extent, multifamily class A, not in terms of the business, not in terms of day-to-day operations, but in terms of the investor standpoint. They want cash flow, and we're going to hold on to this asset long-term many times, as opposed to multifamily value add. We're going to value add this out. We're going to refi. We're going to sell. We're going to give you a big return on your investment 3 to 5 years later.
I will say one thing though, Isaac, our company may be different than others, but we don't always hold on to assets long term, right? So we've done a number of deals where our average hold period is 3 to 5 years. So we're not always in this for a 20-year period. I mean, you could hold a hotel for 20 years and do great at it, but we've found that we like to go into a market, create the value that we're trying to create in that asset, whether it's through a ground up development and going to sell that stable cash flow to somebody else who wants to own it for 20 years, or do a renovation and sell it and move on, right? So our strategy is, maybe sometimes shorter term than others. And you can segregate that from the operation side, the ownership side. Just because we sold an asset doesn't mean we don't continue to operate it, right? So the new owner of it might be a investor in another asset class and keeps us on as management, and they're just the owner of the asset and they enjoy the cash flows and we operate the asset for them. So we've kind of taken a different approach than some of the groups in the market.
I like that. I think the point that also I was making is that it could be that is your strategy from day one when you're speaking to those investors for those specific deals, but it's more that you're not forced to sell. Let's say this property is outdoing what we were projecting. Maybe we could keep and we could hold on to it. When it comes to multifamily, many times, now obviously not every single case, every case is different, but at a certain point, investors want their money back, feel safe that this investment went well, and either recycle it in another deal with that sponsor or invest it elsewhere. Obviously, again, we're comparing apples to oranges, but because I do have a large multifamily base, so there's going to be guys listening to it, they're going to be intrigued about how hotels differ from multifamily, traditional, the Jews especially I'm a Jew. We were born into multifamily. That's what we do. Now you have the guys that go into retail. I actually was at the Hunter conference last year. There's a few fellow Jews there, but it's not so common. I want to ask another question, and then I want to venture for the second half of the show more into our journey, some hurdles that we may have had. But an interesting situation happened last year when I was by the AHOA-Con in Orlando. So I went to one of the panels, and they were talking about cutting costs. Obviously, it's a hot topic. Cut costs, improve and push NOI, and they opened the floor for questions at the end. And I got up there and I was like, "Hey, wait, guys! In the multifamily space, there's such a tremendous stress on like ancillary type of stuff, where you can go ahead and do unique and creative types of services that could really push NOI a lot." And all you've been talking about the whole time here was cutting costs. How much of a stress in the hotel world is there with ancillary services and coming up with certain like different creative ideas, or does it not exist just because based on the whole system, you're not going to be able to go ahead and put and charge? There's these petting things and these laundry rooms, and there's so many things. And obviously in the hotel space, you don't have the ability to do certain things. My question was, why is there not such a bigger stress on it? And they didn't really give me too good of answers. And that's a question I'm going to throw out to you guys. Curious if that's something that you focus on a lot, or it just doesn't fit the play. Mitch.
Yeah, look, this is a hot topic, Isaac. What makes our asset class so different? There's that service business that's layered on top of the real estate, right? So there's a lot that we could do on that service side where other asset classes probably can't do as much on. So look, I'm going to go back in 17, 18, 19, we saw revenue growth, record RevPAR growth, but costs were escalating at a greater rate than revenues, even before the pandemic. Pandemic hit, an opportunity to reset many things. Some things stuck, some things went away. But fast forward to today, we are up considerably over 19, but our expenses have far exceeded our revenue growth. Labor has grown at a greater rate than the revenues. Cost of goods, insurance, and even debt, right? You compound that with debt if you had a refi recently with the higher interest rates. So it has become really, really challenging, our business model. And we've had some structural problems with our business model before the pandemic. And now you could clearly see that it can't be sustainable. So there is a lot of conversations we're having on how can we improve our business model. Every owner operator is having that conversation. That's why it was a hot topic last year at AHOA-Con that you probably saw, is how can we, especially in the economy hotel space, you're right, where they got beat up a little bit more on the revenue side of things. So they feel like all they could do is cut costs, because where can they generate additional revenue? Well, let's talk about two things. On the revenue side, we are absolutely coming up with creative ideas to generate revenue. One is we're all starting to charge for parking now, not just in urban areas, but also suburban areas. And then also destination fees where it applies. Ryan, you have some amazing destination type properties in the New England area. And so it may not apply to a Hampton Inn on an interstate location, but it can with the Edwin Hotel in Chattanooga downtown, or the Grady in Louisville, Kentucky. And they're doing, I just got back from my AC Owners Council meeting last week, and there's an owner that's doing it with all his ACs, and he's had tremendous success, but very, very little pushback. And so we have to rethink our business model. And then on the expense side, I think that I'm a big proponent of this, and I don't want to get myself in any type of trouble, but none of us are public companies, or are we politicians, so we can say whatever we want. And so the industry needs to do this, but payment upon booking with cancellation fees, it has become the norm with the airline industry, with Airbnb. And so why can't we do that as a norm, not as a choice? It needs to be a norm across the industry, teach some discipline to the consumer as well. I think the consumer is ready. I told Tony Capuano this, that I was able to book 4 Marriott properties on the same day in Mumbai, India. And Open Table won't let me book 2 restaurants on the same day, right? We all try to do that, by the way, and it will flag it. And so here are people tying up a lot of our inventory for 360 plus days without recourse. And I think there's an opportunity there. And then also there's an opportunity. Our biggest challenge in operations is in housekeeping, right? I mean, I don't care if you pay $50 an hour. There are certain people that will just not clean 14, 15 rooms a day. They're not going to do that, right? It doesn't matter what the pay is. So it is a really, really challenging in housekeeping. And so the tips, the e-tipping is, I think, huge, and it needs to be on the app. So I've been pushing Hilton and Marriott and all the brand companies like Uber, right? I mean, people don't carry cash with them anymore. They want expense out tips. It can't be this clunky system where you're scanning, a barcode and then you forget. So Uber, when you take an Uber, they're a technology company. We need to be more innovative, right? I mean, we are the probably one of the least innovative industries out there. And so it should all be on your phone. And so it should be on your app. Bonvoy, okay, Steve or Marie or whoever cleaned my room, I could tip them and rate them, click, and if I forget, my next time I'm on my Bonvoy app, they'll remind me, just like Uber does. And studies have already shown that there is a huge take rate increase when you do that. But these are just some examples of many that we have to just be smarter, and we have to be more efficient and make sure that the consumer at the end of the day still gets the value that they deserve.
Before anybody else chimes in, I have a question for you, Mitch. That's literally fascinating. Question for you is like this. Every single time I go to a hotel and I have to pay for parking, I get frustrated. I'm paying you top dollar for the room. Why the heck am I paying for parking? What do you say to people like me?
Yeah, so look, in a lot of urban markets, I think it's become the norm, and it's very customary to have parking rates. And so very little pushback. It's a matter of making sure you're communicating and advertising, what the rate is, what the parking rate is upon arrival, all those things upon check-in and so forth. So this is very new with parking charges outside of urban areas. But those that have done it, including our company, I mean, we're getting very little pushback. And if we do, we'll refund it. We don't want someone being unhappy. And it's not a huge amount as well. But these are the things that we're trying to do to just keep pace. I want to make it very clear to the consumers that are out there, our expenses are exceeding our revenues. The business model, this is not about greed here. It's about sustainability. It's about sustainability. I mean, there's just the business model is not going to work if we don't do these kind of things. And then if you have less hotels out there and people aren't developing them, the rates are going to go up when demand starts picking up again, and the consumer is going to wind up paying a lot more.
That's a very, very good point. It's a good way to look at it. And as well, even to not take things for granted, the fact that I could fly to Boston, I flew to Boston a few months ago, and there's just tons of hotels right there. Like, how annoying would it be that I had to travel 20 minutes out? But that is a great point as well, in terms of the prices definitely will go up if there's fewer hotels. Listen, as the consumer, everybody likes to get away cheap, right? We all love a good deal. But I totally get it. Ryan, I see you have a lot to say on the matter.
I would just add, I like Mitch's comment about the consumer, because we do an exercise internally where we say, okay, if you booked $100 room revenue, right off the bat, there's 9% of the franchise fees. If they were paying the OTA, that's about 15%. Then there's maybe a switch fee, which is like a fixed cost that the brand charges. Then there's a credit card processing fee. So by the time that $100 comes into the hotel, you're looking at $65 to start with, right before we start paying our costs. So I love that exercise, because it really helps team members as well as my friends understand that, guys, we're not just charging all these facility fees, parking revenues just to make extra. It is a sustainability conversation. In addition to all that, Jatin brought up a great point at the beginning is there's capital expenses every year. Every year we're putting more and more hotels. And so, I'm a big direct business advocate, obviously. So going to the hotel website, booking direct, because I always like to tell consumers that, hey, if you're giving it to third party, that's less money for us to improve the hotel and it will impact your guest experience. On the topic of ancillary revenue, in addition to the parking fee that Mitch explained, Isaac, I think it's a form of, sometimes technology is a barrier. So in our industry, we have many different brands that have certain requirements, and the integration of technologies becomes a lot slower. And so we, either on the independent side, I think it's a little bit easier. We have a little bit more flexibility to plug and play things. But, we're doing upsells. We're doing upsells like chocolates and champagne. Early check-in is a very popular fee. Typical check-in is 3 p.m. If you want to come in at 12 p.m., well, there could be a fee for that. We could prioritize housekeeping for that. So we're seeing a lot of success with ancillary revenue. In the industry, what you've seen, a certain amount of years ago, I won't tell you which brands, but certain brands came out and said, hey, we'll never have pets in our brands. Now you see every brand launch, hey, we're pet friendly, right? Major brands. I will think that will only increase for a lot of hotel owners is the opportunity for ancillary revenues. But what's holding us back is the technology integrations. On cutting cost, I totally agree with margins. I generally don't like the word cutting cost because it has a negative tone to it. I think managing costs is definitely a more focus area. And so look, there's great tools out there. There's things that will help us manage our costs better. There's brands that could provide us better support to manage those. I'm a big advocate of doing the basics, right? So if you look at labor cost, well, yeah, it is challenging to get labor, but what is my labor doing on property? Are they being productive? Do I need that extra person on a shift where I'm only have 30% occupancy? So there's different ways, I think, of looking at the business. Cutting cost, from a talent pool perspective, that's still a challenge. When I look at sort of the worldview, we just recently traveled to India in January, in Europe last week, and I see the service disparity between countries. It comes down to team member per person ratio, right? And so we're not able to do that. Local workforce and hiring is definitely a challenge. So in our companies, we handle that a little bit differently. We're very involved in staffing and hiring. We have a centralized hiring process, but we also recruit in other countries using foreign visa programs. Right, we recruit over 300 people in Jamaica and Honduras. We've just invested a lot of capital into the Puerto Rico program, which are by trade U.S. citizens. So that's another opportunity we're seeing to try to bring talent to provide a great service to the consumers.
Interesting. Wow. Cool stuff. Jatin, fill us in.
These guys covered, Ryan and Mitch covered most of the interesting things happening. But I will say that if you're a consumer, you've come to expect certain things. So when you talk about, what we can charge for on the ancillary basis, parking has been one of the newer things, right? You see restaurants, they charge a 3.5% convenience fee. Like, will that come to hotels? Who knows? There'll be some time before that happens, but you also have to get brand approval for these various things, right? So to get the ability to charge for parking, if you're a Hampton Inn or a Courtyard or whatever brand you're in, Hyatt or an IHG product, you've got to get the brand to approve it. And that's a process in itself, right? But as a consumer, if you rewind back, let's go back like 25 years, you paid for internet. Do you guys remember that? You'd pay for the ability to get onto the gateway, and then the first hotel came out with free internet, and then the first brand came out with free internet, and then all of a sudden it's free now. Where for us as the owner, Ryan mentioned there's the CapEx we put in. There's a fair amount of infrastructure that we put in to improve our networks within the hotels from a security perspective, from a speed, just connectivity, just all those things, right? I can't tell you how many times when 20 years ago you plug into a dock or you try to get on the Wi-Fi and it'd be like, couldn't get on. Most people don't have that issue today. If you look at breakfast is significantly nicer now on the continental breakfast side than it was 15 years ago, 5 years ago even. So these guys have mentioned cost have increased. Yes, they've increased, but so has our guest expectation and what the brands require of us as owners and operators. So there's only so much you can cut, right? There's only so hard you can squeeze a lemon before the juice gets bitter, right? And you never want to get to that point, but you still got to at least squeeze the lemon. And so I think that we're finding creative ways to do so, and things like holding, consumers accountable for the bookings that they make and charging cancellation fees, like that's like pivotal changes that'll change the direction of how bookings are made, how hotel operations are done. Until that kind of happens, you're kind of going to see these kind of, clawing at your toe type stuff, clawing at your feet type things that are like parking fees or this fee or that fee and things like that. So
Very, very cool. And me hearing for the first time these types of things, not knowing the ins and outs of the hotel space in terms of operations, but like I know as the consumer that I would pay for an early checkout or a late checkout. I actually just did it recently. I was in the Poconos in Pennsylvania for a midwinter break, and I wanted to leave my suitcases in the room and get late checkout. Like, hey, we have a lot of people. All rooms are booked. You want an hour too late, you got to pay another 30, 40 bucks. And I'm like, okay, it's worth it. So 100%, that makes a lot of sense. And it's cool to hear the other side, because obviously we always hear from the consumer, but to hear from the ownership level, what goes on for you and expenses potentially exceeding revenue. It's not even just about maybe making that extra profit. It's really breaking even and a little more.
Yeah, I will add just one thing on what Jatin said is like, you have brand requirements and guest consumer expectations. So a simple example that everyone could relate to is EV chargers. So now all of us have to install EV chargers, put CapEx, electricity is paid by the hotel owner, and that's a cost. So that's a simple example I think the audience can relate to.
That's really true. And where are you getting that money from? Maybe you'll get that money from the extra 100 bookings for late checkout. Okay, guys, this podcast was supposed to be focused on journeys, but we got a little carried away, which I think actually the audience is going to be very excited because these are great topics. Let's take the next 15, 20 minutes, the last 15, 20 minutes of the episode, just to really focus in on our journey, the hurdles we may have had, and focus in on that. We'll take a few minutes each. So Jatin, let's start with you. Tell us a little bit more about your journey, about any hurdles that you might have had along the road. Obviously, we all know what doesn't kill us makes us stronger. And I don't know if there's ever been an instance that you wanted to throw in the towel, but the idea is that it's not easy to build up a company like Peachtree. Let's just call it what it is. You guys own, I think, over 100 hotels. Is that correct? Yep. You guys own over 100 hotels. You guys have a debt platform. You're probably busy day and night, but there's another point that I would love for you to talk about for a minute or two as well, is letting go. Meaning to say, you're running a big shop. At what point do you stop micromanaging and really fully trust the process and know that you can go to bed comfortably at night knowing that things are going to work out okay? Because that's something that I struggle with. I just hired somebody and it's like, hey, is he doing it right? Is he doing it the way I would do it? Give us a little bit of your look.
It's a very interesting question, right? So I think that part of building a company, whether it's the beginning or along the journey of building one, you kind of look up and you kind of see what you built, right? And oftentimes you're just always looking down and just working and grinding. And that's kind of, if you looked at our company back in 2007, 2008, really even till now, we are all just kind of just working, and we have a goal in mind and a guidepost to where we're going, but we're all just kind of keeping our heads down, staying humble, and just kind of moving the ball down the line, right? When we first started the company, it was, just a few of us here, and we were wearing multiple hats and trying to just move the ball down the field, right? You mentioned bringing, not micromanaging and things like that. Like, I think that's a really hard thing to do when you're the one that wore those multiple hats, but it's also allows you to train somebody and trust somebody and let them make the mistakes and let them learn the way that you did. We have, call it 9 different divisions here at Peachtree that are, adjacent to each other, tangential to each other. And we're able to hire business leaders in each one of those to lead that division. And we trust those people implicitly, and they report up to us, and we help them solve small problems in their shop. We help them solve big problems in their shop. But for the most part, we let them run their divisions. And all that with the one goal in mind of kind of moving the company forward, right? So we grew from 5 people in 2008 to 300 and change people today at the corporate office. So I think the one thing that I discounted is how difficult it is to manage high functioning people, right? It's just everybody's really good at what they do. They're very smart and they don't really need you, but they do at some points, but they don't need you for the most part. So it's really training yourself to let them go and let them do their thing. And fortunately, we've been good at cultivating talent and growing talent. A lot of our team has been here for 5, 7, 10 years plus. So it makes it easier when you've got challenging situations, right? You mentioned giving the towel. I've never wanted to throw in the towel, but challenges. We've done 760 deals in the last call it 18 years, 17 years. So each one of those comes with some level of challenge, and some were a lot harder than others. I think one of the most challenging things that we do is raise capital, right? Whether it's for an individual deal or for a fund. And the best day is when you sell an asset or realize an asset or refinance or something to get capital back to your investors and back to the original capital stack. But it's always challenging from a capital perspective. And I think that today is one of the most challenging times because of like the GFC, right? Like you look at the market today, I think we're down 900 points in the Dow and maybe like 900 in the NASDAQ. I mean, stock markets are imploding. Rates are when I say rates, interest rates they're not coming down dramatically. The 10-year treasury is only down like 8 basis points today. So it's not really moving in tandem with kind of the stock market. So you've got this pressure on the financing side. So the equity market's challenging, the debt market's challenging, and that makes just doing transactions very hard. I mean, whether it's a development deal, an acquisition deal, or us providing credit to other folks, I mean, it creates just this very tumultuous market. So.
Wow. Yep, it's not easy. It's not easy, and especially in today's market, equity is tight and people are putting down their checkbooks. Having esteemed companies that have done things in the space, I'm assuming that all three of you, and I could confidently say all three of you have that edge, that people are going to have an easier time writing you guys a check than a mom and pop guy, because you guys have deals to prove that. Mitch, fill us in a little bit about letting go, not micromanaging, any hurdles that you've had in the last 20 years that really built you up and a little more.
Yeah, look, Isaac, I mean, as a founder, your lens is very different. This is your baby, you created it. I didn't tell you the whole story, but I was that general manager at that first hotel, and then I wanted to do a second one, and I got tired of answering the phone as I'm Mitch Patel at the Homewood Suites. That's hard. And then you're trying to do some other brand with another brand company. So it was a little awkward. So I decided that my first time I kind of let go was to hire my first general manager. That was about 2.5, 3 years into that first hotel. And there was a boardroom on the second floor. And I moved my office up there and took off the little boardroom sign and came up with a company name, Vision Hospitality Group. And that was the beginning of the development and management company. I was the only employee of that company, but I was a proud owner of this enterprise at that time, right? And it gave me confidence that I could do my second or third hotel from there. But that general manager, I'll tell you, he wound up being an amazing, that was probably one of my best hires. And my first GM, not many people could say that. He got it. He had a passion for this business. He actually did even a better job than me running that hotel. We were looking at the expense side of it a little bit more, where he was looking at the revenue side of it. He thought that we could really drive more revenue into this hotel, and he did. And so that just gives you confidence that you can let go and continue to build this company. But the challenges, I just want to touch on challenges that you brought up, 2008, 9, right? The Great Recession. I mean, that shook every single, it doesn't matter what industry you're in, especially in any real estate class that you're in, and particularly hotels got hit really hard. But, we had a small portfolio, about 7, 8 hotels at the time. But we looked at our portfolio and said, we're doing something right, guys. The market's down like 17% and we're down 4 or 5%. So it was down, but it was something you could call least bad, right? Or less bad. And we said, there's something here. And we actually came up with a plan and grew this company, more than doubled it in the next 3, 4 years. And we're talking about one of the darkest hours. Instead of fixing our portfolio, we went out seeking opportunities. And as Warren Buffett says, when investors are fearful, you should be greedy, and greedy when others are fearful, right? And so when investors were really scared, we were looking for opportunities, and those opportunities aren't always going to come. And we developed, I think, 14 hotels during that time. And Jatin, Peachtree, I remember when you guys had just started, and Greg reached out to me and said, we've got this hotel in Indianapolis. Can we JV on it? And we developed it and we operated that hotel for you guys. And look at where Peachtree is today. Obviously, you guys do it all. And so it's a great story how we came together at that time, and it made sense for that particular venture. But fast forward to 2020, as you know, massive challenge for our industry. And talk about day-to-day leases. Well, we saw the worst of it when our 80% or 70% occupancy dipped down to 10, 15% overnight. And so it was definitely a wake-up call. We had to make some really, really difficult decisions and heartbreaking decisions, but we did it and we overcame it. And I just want to say that you got to fundamentally believe in this business. I'm so thankful that we're in the experience business. The experience economy took over the goods economy a little before the pandemic, and it is now just accelerating. And so what I learned during the pandemic, within months after the pandemic hit, we had 60+% occupancy at many of our hotels, even 70% occupancy at some of our hotels. What I learned is never bet against American spirit. It's just really remarkable. There wasn't even a vaccine out. People didn't even know what an impact it would have on people's lives and health, but people wanted to travel. People wanted to see each other, wanted to go on vacations with their families. And that gives me a lot of confidence and a lot of hope that it's not easy, like Jatin said. There's a lot of challenges. But there's another quote that I love sharing. It's an old African proverb: smooth seas have never made a skilled sailor. So these challenges, these choppy waters, these storms, 2001 and the Great Recession and then the pandemic, has all made us stronger, has made us resilient, made us smarter, more efficient. And I think that makes us better hotel owner operators going forward. And I think that's what I've learned. I'm thrilled that I get to surround myself with an incredible team. And I can't talk about anything without talking about culture. This is a people business, first and foremost. We're all operators here, not just pure real estate owner developers. And so if you are an operator, you get it, that this is a people business, a people serving people business, and culture will ultimately define your destiny.
Wow. I'm just going to add one thing, and you're literally talking my talk. I'm an avid NBA basketball fan, and I might get killed for this. I'm saying this on air, but I'm a big LeBron guy. I grew up in Cleveland before I moved to Michigan. Now I'm in Jersey, but that's where I grew up in Cleveland until 8 years old. Then I moved to Michigan. And I always say LeBron's championship against the Warriors in 2016, and he always talks about it, that's who made him who he is. Meaning to say, obviously, he was so good before then, but that was his proudest moment in his life. And obviously that was so hard coming down from 3-1. And I can remember, and he was crying after he won. And obviously bringing a championship to Cleveland, but the idea that he went ahead and went against probably the greatest team of all time. And I love that message, and it's something I incorporate into my life every day. And actually, a moment that happened around 5-6 months ago. My little kid is 5.5. He's 6.5 years old, but then he was 5.5. And he was playing basketball in the driveway. And he's a little kid playing on a real basketball hoop, and he's shooting from 12 feet away. And I told him, Joe, why don't you go closer? He's like, if I go closer and I don't shoot from far, I'll never learn how to shoot from far. And I literally almost broke down. I was so happy, wow. And that's what it is. It's doing the things that are hard, and that's what makes us stronger. And yeah, I can't imagine, obviously we don't have time for that, and I know we're over time right now. I can't imagine what you guys went through and fellow hotel owners went through COVID. It was probably really hard, but like Mitch, you said, what doesn't kill us makes us stronger. And that's what you really learned to pivot and really learned how to take these situations and learn from it. Ryan, let's end off with you. A lot of good stuff was said already. Fill us in just about the letting go, about the fact that maybe brokers want to talk to you. We're going to sell you a deal. We want to talk to Ryan. We don't want to talk to your director of acquisitions. And just in general, hiring that general manager that potentially could be even better than you. Yes,
Yeah.
it's possible. You know what I mean? Like Mitch said. Fill us in.
I think everything starts with clear expectations. So every one of us have many people working for us, and we work with many people. Clear expectations. I remember when you first reached out, I said, look, I'm not the guy to do this. Just text me if you need anything, because I won't get on a call with you right now at this point, right? Like wasn't a wrong thing. It's just, look, this is my working style at this moment. I think it's setting clear expectations. And then, the other thing is, I'm a strong believer. You got to know the details of your business. I think, a lot of young hoteliers or investors, depending on what you're trying to accomplish, you got to know the details of what you're trying to do. You don't have to know them today, but you have to have some level of curiosity to learn, ask questions, participate, listen. I also think I'm a big believer also setting measurable KPIs. So that way you don't have a bias when you're evaluating, your leader or whatnot. No, with all that being said, I will admit it is hard for me to let go, just like I'm sure the others. At the same time, I'm actually open about it with the company. I say, look, I get that I'm kind of anal, right? And so you tell me if it's too much, but it's also my job to create the sandbox, and then you do what you want in the sandbox, right? And if I see you're getting outside the sandbox, it's my job to raise my hand and alert that, right? So I'll keep that concise for now, but we're kind of a little bit late on time, but that's how I would look at it.
Okay. 90 more seconds and we're done. Ryan, a one-liner to a newbie investor. A one-liner that you see him, give him in the grocery store, 10 seconds.
Always build your network, be people first oriented, and number 2, I would say know the details.
Love it. Mitch, a one-liner to a new hotel investor.
Yeah, look, just educate yourself before you invest in anything. And there's a lot that goes into the hotel space, which you heard today, but invest with good people at the end of the day is what I will leave you with.
Beautiful. And Jatin?
I would say just do it, because all of us had an idea of what we wanted to do, and we figured it out along the way. And nobody really knows until you get into it and actually do it. So just step in and do it.
Love it. Just do it. I love it. Guys, this was incredible. I'm excited. Thank you so much for tuning in to today's episode. What an episode. What conversations. Unbelievable. Definitely exceeded my expectations. Hope it did for you as well. Thank you again to our guest. I know you took time out of your day today. This was unbelievable. Thank you so much to our sponsors. Definitely folks you guys should reach out to, each and every one of them. Have a great day. See you on episode number 2.